So about 15 years ago, when I was fundraising for my business called Buzu, I hardly met any investor who had ever built a business beforehand. And it's always cited as one of the reasons why Europe is lagging behind the US. Because in the US, about 50% of VCs have entrepreneurial experience, and in Europe, it's only roughly about 17%. But it seems that times are changing. More and more successful founders are now turning to become investors. But the question is, should they? Is it actually true that founders who are now turned investors are the better investors? And most importantly, what does it mean for now founders raising money from entrepreneurs who are investors? How should they do it differently? So these are the topics we're going to cover in this panel. My name is Bernhard Niesner. I'm the co-founder and ex-CEO of Buzu, a language learning app that I founded out of Madrid in the year 2008 after doing an MBA at IE Business School. I then moved the business to London, scaled it to a bit over 100 million users. I was very bad at fundraising. I only raised about 16 million euros, but luckily then I managed to sell it for over 400 million in 21. And I have now turned to be an impact investor in the pre-seed and seed stage, focusing on climate and education. And it's a big pleasure to be sitting here with an old friend of mine, Renaud, one of the co-founders of Eventbrite, a ticketing event platform that he co-founded and then IPO'd in the year 2018 for close to $3 billion US dollars. Then I think he did a bit of angel investing, and he's now a general partner at Slate VC, a climate-focused VC with about 250 million, focusing on A to C rounds on companies in Europe. So welcome, Renaud.
My pleasure.
And so the first question I would love to ask, also as an entrepreneur now turned investors, why do we actually do that? I mean, there is this myth that probably we're a bit unemployable, so it's unlikely that we're going to work for someone else. But you did a bit of angel investing. But why did you decide to then become a VC, especially in a sector where you didn't originally come from?
I think it was a long journey. I always turned my hobbies into the next job. So I was a civil engineer when I started my career. I was building websites. It was during the 95 to 2000 period. The web was exploding, and I was playing with code, and then I became a software engineer in 2000. And same with investing. I started playing with it as an angel investor in 2013 when we had our first secondary at Eventbrite. Enjoyed the conversations I was having with a lot of diverse founders who were very excited about their opportunities, and I thought I could contribute a lot to their problems, having lived through inception to having 1,200 employees doing an IPO and all that comes after that. So that's why slowly but surely I thought I could become a venture investor. I didn't jump from one day to the next. I joined other firms. So I was at Index Venture for a year as a venture partner, seeing how our transatlantic partnership works, and it's not easy. There are people in San Francisco, people in London, some in Geneva. They have to coordinate, and they always had great discussions about the startups they were talking about. I learned a lot about what makes a great team, all the way from the partners to the supporting team, the marketing and PR functions and all that are very important for building credibility in the venture space. And then I went on the other side, on the operating partner side with Point 9 Capital, a firm in Berlin, to better focus on the 0 to 1 and a small firm. There were 3 partners, I think, at the time when I joined, so very small AUMs, but a very different spirit, much more family-oriented and a great track record also. So I was very interested in learning from existing funds. And then we spotted an opportunity, I think. We started investing in climate with, I would say, my first co-founder in the fund, another successful entrepreneur who sold his company. And then we did 20 angel investments in climate. We met hundreds of founders. We did 20 investments, but in the process, we met a lot of the VC community in climate. And it felt refreshing, I would say. Not very competitive like the VC world can be. It was the beginning of climate, so we all had great hopes of fixing the world and contributing in a big way to the problem. And I think that's what attracted me to the space. And we realized that there were a lot of funds focused on the 0 to 1. How do you find product market fit in the early days? But very few funds that were competent and could give good advice to the founders. A lot of them with no industrial experience, for example. So they come from either some other corporate world or from tech, software tech, and trying to disrupt chemistry and other fields where they knew very little about. And I found the challenge very exciting and a great way for me to contribute what I had learned for 15 years building Eventbrite and put it into a fund. The growth stage is equally as hard as the 0 to 1. You have to build from a small team to a very large team. You have to build processes, you have to build governance, you have to find your right pricing, you have to build the right partnership along the way if you want to have liquidity, like the previous panel talked about. All this is complicated, and in 15 years building Eventbrite, I learned a lot that I thought could be very valuable to share in a fund structure with the founders that we back.
But just to double down on climate tech, because from my experience now investing in climate, it's mainly hardware. And suddenly, I meet founders who are doing some synthetic cheese in a lab, and I come from edtech, and it's not much that I really understand about that. How difficult was it for you to come from a ticketing platform to suddenly now dive deep into energy transition?
I mean, I'm an engineer by training, so I understand some kind of complexity, but I'm not going to become a scientist and become the best expert in fermentation or other things. So that's why the growth stage is much better for me personally, because the problems are very similar across all different industries. You have to build a team, decide where you expand, build processes and governance along the way. And this is applicable to any field. So I really love the subject matter. I learned a lot. That was also one of the reasons I wanted to become a full-time investor. It's very exciting to work with founders who know deeply what they're trying to disrupt. So we trust them, of course. We have our own network of experts who can come in if it's a specific topic that they are relevant for. That's also what we come with as venture investors. We have our own network that we built over many, many years, and we have very different profiles on the GP teams, and we wanted it to be this way. Just like a startup picks the best people in the marketing department, the sales department, like we thought the GPs of Slate needed to be coming from fast growth software, but also industrial reality and we have a partner from McKinsey who was 20 plus years in the field of industrial climate, who joined us, and it's very helpful to have his point of view on how fast realistically can we scale in these very old entrenched industries that don't really want to change. So
I think another important point is why entrepreneurs turn investors. I mean, let's face it, if you, also from my experience, if you do a business, it's probably going to be a 10 to 15 year commitment. And in my case, I was 15 years in the trenches. I didn't want to necessarily now commit to another business. And the chances of success are relatively limited. Whereas actually, if you become an investor, you can use your knowledge, your resources, your network to empower other people. And I've made over 30 investments myself, so hopefully I can actually have a bigger impact in the world than rather than just doing my next business. Is there anything you miss from being a founder? The long nights?
The what?
The long nights?
No, I don't miss that much. I have 2 kids now. I didn't have them before. I miss the empowerment, having a big team that can produce a lot. That's quite exciting, I would say. And you make plans, and 3 months later they are realized. Whereas as investors, we make longer term bets. We don't know if they're going to pay off. So it's a very different job. I don't miss the big company vibe. Like
I remember I visited you in San Francisco in your offices, and for me you were like, wow, an accomplished entrepreneur sitting there in these big offices with all the engineers. It was impressive.
You know, that's what's weird when you're a founder. Like at the beginning, you know everyone, and then you're 100, 200, 500 people, and then you go in the elevator and people don't know who you are. It's a weird feeling to be a founder of a company and the employees don't necessarily have had any contact with you. So that's also how we help founders handle the growth, because it's not easy. Like, you have to reinvent yourself. I'm sure you had to do it a few times.
Yeah.
You have to figure out what the right role is for you inside the structure, and for me, it wasn't obvious all the time. You have to learn different skills, how to navigate a large, complex organization, how to have multiple sites across the world, how to cope with COVID that came, and we had to fire half the company and restructure, and so big things like that, that if you haven't lived it from the inside, you cannot just read in the books. It doesn't work.
All right, let's come back to the main topic, which is are entrepreneurs turned investors really better investors? And there was a study by Harvard Business School in the year 2022 that looked at that quite in detail. And there was one group of entrepreneurs turned investors that had a 6.5% better performance compared to the normal financial VC. And there was another group of entrepreneurs turned investor who had a 4% worse performance in their investment. Anyone has an idea what the difference between the groups of entrepreneurs were, one being better and the other being worse? Well, whether they were successful entrepreneurs or not. Pretty obvious, right? So the successful entrepreneurs somehow, made much better bets, and the study attributes it to the quality of the deal flow that you can get when you're a successful entrepreneur rather than when you're an unsuccessful. So I think it's probably also a tip for the entrepreneurs. Always look up whether the VC was a successful entrepreneur or actually not really. So what do you think, Renaud? Does being an entrepreneur or having had a company beforehand, does it actually make you a better investor? And if so, in which part of the value chain of the process of the investment does it actually really help?
I think investors it's a very personal job. It matters who the person is, and I don't think we can generalize. Yes, there are stats, and they're all interesting. They show maybe trends, even though 5% is not very much. But I've worked with a lot of GPs. I know a lot of GPs, and some of them bring different things to the table. Some of them are very successful as financial VCs because they've understood the game. They apply it at the right level, at the right moment with the founders, and it just works for them because they've learned through repetition of being exposed to different problems. I do think we come with operational empathy, which makes ex-founders much more appealing to future founders. Even for other VCs, like we get referrals a lot because they think we can help the company go to the next stage. So that's where being relevant for a particular stage, understanding the space you're in, and even though I didn't do hardware before, I still understand the complexity of selling to industrial players and the different profile of revenue curve that you can expect from this type of businesses, where it's much more of a step curve if it works, rather than software, which is much more gradual and hopefully accelerating. So there, I think operational empathy is one that we are definitely much better than, I would say, a financial VC. Access to deal flow. People want us on their cap table usually. If we've proven we can work successfully with founders, which is a big if also. A lot of founders think they have all the answers, and when they go into venture, they apply the same recipes that made them successful. Most times it doesn't work.
Yeah.
Like different organizations, different products, different industries, you have to think much more strategically about what this company need in this time with this particular composition of a team to go to the next stage. And that is not a recipe book that you can just apply blindly.
Yeah, absolutely. I mean, what I've also learned with my portfolio, that I guess as an ex-player, you kind of want to play as well, but you're no longer the player. You need to cheer from the sidelines. And also, not every founder is coachable. Let's be honest, there's quite a few people out there who really believe that they know what they're doing, and while you think you might give them the right tips, they just don't want to hear it, and you need to accept that, because you're no longer driving the bus.
Well, you probably shouldn't invest in those, but that's
true,
question.
And it's very hard actually to identify the ones who are less coachable, at least that's what I've learned.
That's one big criteria for us.
Yeah.
Like, do they listen? They don't need to do what we say, but they need to take it into account and think it through, and hopefully it helps them get to the next step of their growth.
Yeah, absolutely. But there's probably also a trap where you, as an ex-founder, think you know it, and actually you don't. So what do you think, what type of characteristics actually work against you as an ex-founder turned investor?
So before I started Slate, I took on some boards, scale-up boards, just to see how other organizations were doing things, what kind of problems they were seeing at 200, 300 people. I also did 80 angel investments before, all different stories, different ways to grow. So that was very important for me to not try to replicate what we did at Eventbrite, which was very specific to our industry, to the being in Silicon Valley, a lot of things that are not easily translatable to other businesses. So getting a broader view of what's possible, and I think being a good board member is not given to everyone. You have to not want to be in the seat of the CEO or the executives. You have to give practical advice is both practical but also long-term strategically relevant. And that's not easy, so you have to learn that trade of being a great board member, I think, to be useful.
Absolutely.
The trick is not to fall into wanting to do the work for them or being too close to the team that executes. Like, you should ask them to present what their plans are, but not build a plan for them, which I think a lot of...
It's really counterintuitive as being an entrepreneur, right?
Exactly.
Yeah.
So that distance is necessary, I think, to create a good working relationship where if you're too much in the weeds, then it's really your problem that you're creating by trying to impose something on the team, whereas most of the time it's that the team is just not good enough and that you need to step up the leadership of that team to really get what you want.
Yeah.
So I've had difficult board discussions with founders who didn't really want to be CEOs anymore, for example, but they didn't acknowledge it until we had proper discussions outside of the board meeting, which is also very important. Like, long term, what do you want to do? How do you see yourself grow into the organization? How do we fill the gap if you leave? And that is very difficult decisions that are much more acceptable if they come from another founder who I did it a tactful way. In the end, they picked a different CEO, and they're all happy, and they're all still involved and excited.
Yeah, I think you're touching on an important topic, which is also the empathy, right? And you're probably in a more complex situation because you're investing the money of other people. I invest my own money, and I try to invest it in people that I actually also like and that I enjoy working with. And sometimes I believe this empathy also goes against you. So I've definitely written then also some bridge round loans that I shouldn't have because I was feeling for this entrepreneur who was struggling, and I remembered myself being in that situation, and then you write the check and then the company goes bust. So I guess that's what professionals, VCs, I would argue, probably a bit better. They're much more the Excel junkies, as I used to call them when I was an entrepreneur, and they mainly focus on the numbers.
But that's also where the value of a partnership lies. Yeah. Different opinions, different ways of thinking about the venture. Even if you get excited, you still have to convince 3 other people on your investment committee that this is the right investment for the firm. So I saw that at Index and Point9. They took a long time to make decisions, sometimes a long time in terms of minutes and hours, not necessarily weeks and months, because you need to go fast. But there was a work involved in convincing the others and building the case for this is the greatest startup we can invest in now.
Yeah.
Which I admire solo GPs and angel investors. I was one, and it's much easier when it's your money. When you take other people's money, you have a different type of responsibility that we take very seriously.
Absolutely, right. Start preparing your questions. We're going to have a bit of Q&A at the end. But before we come to that, let's talk most importantly about what it means as a founder in the room if you're pitching to an ex-founder. What do you think you need to do differently?
I think on pitching, we come with more understanding of where you are, because we were in your shoes before. So I think trying to hide the reality is always dangerous. We'll find the needle in the haystack that will make us kill the deal if we think either you're hiding things or you're not being honest or you are in a worse stage than you actually are. I'd rather have honesty about knowing your own organizational weaknesses, for example, and where you want to use that capital that we're going to give you to reinforce the team. That's a much more practical way of getting our ticket in the end. It's more after that. Like the relationship, I think, with a board member that is an ex-founder is not the same as a board member who is a more financially driven investor. Like we understand what makes a company successful on the inside. So trying to tell us that it takes 6 more months when we know it's an easy job because we've done it as product people ourselves. Yeah. We can call bullshit on a lot of things, I think, or excuses or reasons that are not valid. So there, I think, getting to know your investor very well, understanding what you can talk about with the different people at your board table is very important for you. Taking money from the right investors who can really help you at the stage that you're at. Also, very boring tip, but I see too many companies taking money from investors that never reference checks. Yeah. And I don't get it. Like, you're going to spend 10 years with this GP at your table and like you don't even know what the others think.
Dating beforehand, yeah.
So that's part of your due diligence on understanding what that person can bring, whether their experience is relevant for you or their way of thinking about the world. And I see a lot of my role is, especially in Europe, where we kind of feel small compared to Silicon Valley and don't want to disrupt too much. And you see a lot of venture investors protecting what they invested in rather than thinking big and thinking, how do we get to be the biggest company in the world in our space? And that type of drive and saying, yes, it's possible, you just need to do blah, 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 and very generic, and hopefully it's applicable and works. But this is also one of our roles, is to bring back what we learned in a very successful ecosystem and apply that to Europe. So hopefully we can bring that to some founders.
Yeah.
Who's a founder here?
Founders, please raise your hands. Okay. The rest are all investors or corporates or
tourists?
A bit of a mix. Tourists, exactly. Yeah, I mean, for myself, being an angel investor, obviously the personality of a founder, I think, is even more important at the early stage. And I tend to invest on the 3 Ps, as I call them. It's perseverance. So has this person already gone through some sort of hardship or likes long distance running, for example? Positivity, because you're going to go through a lot of difficult times in your life. Hence, I like people who are just a bit more optimistic in life. And then most importantly for me, which might be different to the institutional investors, is like passion. I mean, you really need to burn for the problem that you're trying to solve. And if already in your pre-seed deck you tell me how you're going to exit the business in a couple of years, it's an absolute no-go, because ideally you love that business so much that you never want to sell it unless someone really comes with a really big check. So last question. I mean, now I'm also an investor as an LP into VCs, and I have to say, there were a few things that surprised me about the VC world. One being, for example, the management fees. They're quite comfortable at some point. But that aside, like, what would you wish you had known when you were a founder about VCs in the VC world that you know now as you're an investor?
Maybe having VCs at the table that understand that their value is limited in time. And I think in Europe we make the mistakes of keeping our investors way too long at the board. I think the value and the contributions to venture investors is probably only worth 3 or 4 years of their time on your board. So that's something I encourage all my investments to do, is start diversifying your board very early. At IPO, you don't have any investors on your cap table, on your board. Usually, we had Sequoia, because that was an exception. They had a lot of the firm, so it made sense to have them. But overall, like early stage, they shouldn't be there at Series C, D, Series A, probably not either. So think about that. And then understanding the world of VCs, like we have LPs, we need to return money to them. We invest in you because we think you can make an exit somehow in the next 10, 15 years. Yeah. Hopefully 10, not 15. 7 would be even better. But it has to be big. It has to be a big multiple. It has to be possible, achievable. So this is all the things we are trying to know.
Yeah.
For our LPs, like we work for our LPs in the end, and that's what happens when you manage other people's money.
Yeah, absolutely. I think that I didn't really think too much about it when I was an entrepreneur. You just believe the VC is the one, but in fact, it's just one fish in the whole food chain.
And even LPs have LPs. So.
Exactly. And yeah, I think that was also my learning now, investing into VCs myself, that it's actually not a great asset class in general. A lot of VCs actually struggle to return even public market returns, because it's such a power law that just a few return a lot and then the rest they necessarily don't. And also that they have automatically the need to focus on the winners in the portfolio. So because that's the fund returner and the rest, it don't really matter that much anymore. So hence, ideally, you need to be the fund returner, because if not, you're not going to get a lot of attention. And I think it's also a bit of a numbers game, because you might just not fit in the focus of the fund or just the timing. They might only have like a couple of years left in the fund cycle. So always research also, how long is the fund, when are they going to raise a new fund? And maybe just right now they don't have the money or the willingness to take another risk. So there's nothing to do with you. It's not you, it's them, So I'll keep on pitching. I think I received over 100 rejections from VCs, and I wore them as a badge. All right, do we have any questions in the audience? There was one in the back, please. I can't see you, but I think there's a mic coming to you.
Hi, good morning. I have one question. I mean, based on the mantra, fake it until you make it, and considering that you guys have been founders in the past and now are investors, do you think that now you approach potential companies to invest in a bit more of a prudent way, or a bit more of a reluctancy? Just how is your approach now, and how was it before eventually?
I think it's a dangerous advice, fake it until you
Yes,
make it.
I wouldn't follow
I'd
that.
say it works probably at the beginning, but at some point you have to be more professional. At growth stage, definitely we don't invest in fake it until you make it,
Yeah.
and you probably haven't made it if you faked it too much, because eventually it comes out and we realize that this is not what was sold to us.
Yeah. I would agree. I mean, as a strategy, I don't think it's really a good idea, because even in early stage, you need to show some sort of traction. And now it has never been easier to build a business in these days than ever before. So you need to have a good product. You need to have a clear go-to-market strategy. You shouldn't fake any of that. So I wouldn't advise that.
I think you can fake a few things. Like we've seen great companies, they have 20 million in revenue, and it's a no-code solution that they built with the tools that exist today. So I don't know if it's faking it. It's just not what you would expect from a serious company in the past. But I think AI tools are so good now that you can go a long way without necessarily hiring real engineers.
All right.
And that's going to be even harder to understand if you're a venture investor, how solid the platform is. And we're going to have to do a lot more tech due diligence, I think, on these businesses.
Absolutely. One more question. I know we're out of time. Yes, please. Here in front. Mike is coming.
Hi. Quick one. So I think SF has definitely sort of supremacy in terms of the ecosystem and in the world of startups. But I think there is a new archetype of sort of like renaissance of European VC ecosystem in Stockholm. And I was thinking if there is anything that we should actually learn from founders like Ligora. I think Ligora is an exceptional product because they're not trying to sell, they're trying to integrate something, and they're always talk about workflow. And I think in terms of problem solving and product, it's pretty innovative. But I mean, legal tech is such a competitive and niche market, and I'm wondering, what is it, like why Swedish founders are so exceptional? Because not only they build exceptional products, but they know how to scale them. Thank you.
Okay. I mean, you're asking here an Austrian and a French guy, so why are the Swedes so great?
I think it's the small country syndrome. Israel's been really good. They cannot live on their own markets. With Sweden, it's the same. France is too big. We have a lot of French clients potentially, so French companies tend to focus on their French clients, which is logical. But in Sweden, you don't have a choice. And there's a great ecosystem. So many success stories from Skype to Spotify that have trained hundreds of very competent people in the way that fast scaling implies. And I think that this talent makes it possible for the ecosystem to over-deliver compared to the size of the country. So very excited about other countries that have had this, not mafia, but ex-operators that then become entrepreneurs themselves.
Right.
Because they've gone through a lot of ups and downs, the same that we have. Maybe not as founders, but as operators, and some of them for 10 plus years in these companies. So they've seen a lot, and that's what makes the next one very successful.
All right. So rounding up, I think it's fair to believe that successful founders turn into better investors. They can hopefully be operationally helpful as well. Make sure you do your research on them and bring your passion to your pitch. Please join me in a big round of applause. Thank you very much.